Hi there, I'm Angie Austin with Oil and Gas 360, and we are here at EnerCom's 2017 Oil and Gas Conference, and we're joined by Kathryn Miller, and she is the partner and managing director with BTU Analytics. Welcome, Kathryn.
Hi, thank you.
All right, let's start with your market analytics. BTU Analytics specializes in energy market analytics, so what are the biggest changes that you're seeing in the energy markets in 2017?
I think when we look back at this year and think about the big seismic changes that really will have impacted what we've seen, it's really going to come down to two things. On the oil side, we've seen that the U.S. has really displaced OPEC as swing supply in the global markets, and that's a real seismic change that we'll look back on and remember 2017 for that reason. And beyond that, in the gas markets, we're really at the point where we're ready to unleash the potential of U.S. gas. We're going to have about 5 BCF a day of new projects that are coming online out of the Northeast over the next few months, which are really going to allow, for the first time, producers in that market to impact what's happening in the greater U.S. and, in fact, global markets.
So actually becoming more of an exporter than an importer?
Well, we're already at that point with both oil and gas. But going forward, we've seen us grow from just being able to displace imports coming into the country to being able to send out our own LNG forecasts and our own excess crude oil, which is really important when we're thinking about how to keep the market from being too volatile and having those really painful cycles in North America.
Right. That's neat. All right, so what direction is the North American shale industry headed in right now?
Yeah, I think we're seeing a really interesting shift within U.S. shale as well. We had this kind of land grab over the initial few years in U.S. shale. And over time, we've seen a shift from grabbing and capturing resource to figuring out how to develop it at a low cost. And that's been important because as we really integrate ourselves more with global markets, many of those global markets are able to actually produce at very low cost. Now they have to subsidize other programs within their countries, but being a low-cost producer is important for us if we're going to continue to grow our own production in the U.S. market.
Let's talk a little bit about costs. Give us your outlook on service company costs and what impact they might have on break-evens in the shale plays.
So there was a lot of talk earlier this year about what impact service cost inflation might have on the cost to break even, the cost to produce in North America. And we've seen some service cost inflation, but actually U.S. producers have done a fantastic job at continuing to have greater production from individual wells. They've been able to offset some of that just service cost inflation by having more productive wells. And so when we look at the greater economics, even though we still expect service costs to inflate another 10% based on historical norms over the next 6 to 12 months, we expect that producers will also be able to increase their own productivity and kind of have a net wash on the economics and the break-even of U.S. shale.
All right, how will the volatility in the oil markets affect the upstream industry in the next year, Kathryn?
Well, unfortunately, producers can be their own worst enemies. And I think U.S. shale has shown time and time again that if producers are required to innovate, they will. And we continue to push the cost to produce oil and gas lower in the U.S. And as we do that, there's excitement, there's capital that rushes in, and we build momentum. And that's what we've been doing over the previous year, is adding rigs to the field, adding service and completion crews to the field, and we haven't yet seen the production from that. And we do think that that will come online in the back half of this year. And as that happens, we do think that it will push oil prices lower. Now, as we get some of that oil price volatility, we do think that producers are better prepared to push through and continue to run low-cost operations. But there still will be some hiccups as we have companies who are up and running and efficient operators, and we still have other companies who are pushing through the learning curve and trying to figure out how to be low-cost, really making that transition from just land grab and growth.
Wonderful. Anything else to add?
I think we covered a lot, actually.
Excellent. Well, thank you, Kathryn. Again, Kathryn Miller, partner and managing director with BTU Analytics. I'm Angie Austin with Oil and Gas 360. Thanks for joining us.